A very good afternoon to Mr. Amit Chandra, or Amit as he has asked us to call him, our mentors, Mr. Vishnu Dhanuka, Mr. Sanjay Bhuwania, and to all the members of Millennium Mams who are present today for this session. So let me start with a brief introduction about our organization. Millennium Mams is a not-for-profit organization founded in 1993 by our mentors with the sole motive of creating financial literacy and awareness amongst women. The organization has multiplied many folds since then, and we have been able to touch lives of more than 7,000 women till now. The curriculum imparts knowledge of financial literacy through study of business dailies, understanding the current affairs, understanding the balance sheets, analyzing the ratios, attending the AGMs, as well as factory visits. We have chapters in Kolkata, Mumbai, and Bangalore. And we also invite stalwarts like you, sir, to increase the bandwidth of our knowledge and use it further for our studies. Coming to our guest of honor for today, Mr. Amit Chandra. He is the founder of the Mumbai office, a partner, and the chairman of India for Bain Capital. He is the member of the Financial and Business Services Vertical and a member of the Asian Pacific Leadership Team of Bain Capital. Before joining this company, he was at DSP Merrill Lynch, joining at the bottom, and in over 14 years, he rose to the top and helped to build India's leading investment bank with a reputation for high market share, customer trust, innovation, and relationship orientation. He retired from DSP Merrill Lynch in 2007 as a board member and a managing director. He changed career at the peak and left banking at a relatively young age to move to investing. The second phase of his professional career has been founding the India office of Bain Capital and being a part of its Asia leadership team. Over 15 years in Bain Capital, the company has emerged as amongst the leading foreign private investor in India-centric companies, with the reputation for doing some of the largest and most marquee investments like Axis Bank, Genpact, Hero, IIFL Wealth, etc. Mr. Amit has been a trustee of the Tata Trust, chairperson of Give India and the Akanksha Foundation. And he is on the board members of Tata Sons, Piramal Enterprises, and Genpact, amongst other corporations. He is the founder, trustee of Ashoka University, a member of the advisory board of Bridgespan India, and a Center for Social Impact and Philanthropy. Amit is a BEA, MBA, and was named a young global leader by the World Economic Forum in 2007. He has been a part of building some of the largest institutions and movements that serve society, like the Ashoka University, SRCC, NH Children's Hospital, National Plan to Regenerate Water Bodies, Give India, etc. He has also co-founded the ATE Chandra Foundation with his wife Archana. This foundation works very closely with non-profits and governments to design and scale solutions that impact the most marginalized population. The couple has been listed in Forbes Asia's Hero of Philanthropy list in 2016. He spends half of his time in the social sector as a co-founder of this family foundation that works in 5 states. Mr. Amit has had a stellar stint in both business and philanthropy as the MD of Bain Capital and as a thought leader whose portfolio approach to investing time and money into a range of initiatives has helped advance and maximize the foundation's social impact. A gracious giver, an investor in knowledge capital creation, a practitioner of passion, and a data-driven philanthropist. This is what defines our guest of honor for today. Welcome to our forum, Mr. Chandra. We are really looking forward to this enriching session with you.
Thank you so much, Preeti, for that very generous introduction. And thank you so much for what you do. I think your mission is an invaluable one. And I hope that you all are able to complete the work that you all are doing so that literacy amongst both men and women is at an equal level, at least in the next decade, if not longer. Thank you.
Sir, can we start with the keynote speech by you?
Sure. I know that many of you all had questions as well, which were sent to me in advance, and I thought they were really thoughtful questions. Answering them alone could easily take up most of this call. So I'm just going to open up with a few points, not too many, and I'm going to maybe talk more about the economy, touch upon the markets a little bit, given that that's what your forum is most, is the core purpose of your forum. And then with your permission, we can open up to the Q&A. If there are additional questions at the end of it, we can take some of them as well. Okay, is that okay?
Okay. Yes, sir.
Terrific. Yeah. So, look, I mean, I think, we're coming off a very interesting time in history. If you would have actually told me to, step back and think about where India would have been 3 years ago in the middle of COVID, I would have actually never have predicted we would have been in the position that we are in today. And so from that perspective, the glass looks actually pretty good at this point of time. Of course, for many, there's a deep sense of disappointment because COVID has actually set us back probably at least 3 years as an economy, and at the bottom of the pyramid, even longer. And so depending on how you want to look at it, I think the Indian economy is probably, half empty or half full. But I think if you really step back and think about it, the reason why I say it's really interesting is if you, travel the world or you belong to an organization that invests globally, you really begin to appreciate India's trajectory as well as the absolute state of where things are at this point of time in the country. What do I mean by that? I think if you look at all the major economies of the world, the top 20, 25 economies of the world, even with the wide range of forecasts that exists at this point of time, this is one of those periods where nobody's really quite sure as to how quickly we are going to grow in the next 12 months. I've seen ranges anywhere from 5.5% to 6.5%. But let's take the midpoint of that 6%. Even at 6% GDP growth range, if you really look at that and compare it to the other leading economies of the world, the other top 10, 20 economies of the world, it's actually quite remarkable. It's remarkable because Europe is seeing economic reality which it hasn't since World War II. It's truly being challenged in many, many ways, not just geopolitically, but economically as well. The US is actually not looking too bad, but is beginning to show signs of slowing, and everyone is beginning to hear about the layoffs. Those are generally a good precursor of things to come, and so we do expect growth in the US to rapidly decelerate from here on. And our big neighbor China, which was really the world's engine for growth for many, many years, is actually facing a number of homegrown challenges, including in its internal high level of leverage, excessive controls it's beginning to put on entrepreneurship, people wanting to a lot of talented people wanting to look elsewhere. And for the first time, we're actually seeing China decelerate at levels and grow at levels that we were generally not used to. Of course, many global firms which wanted China to, be its back office, be it for manufacturing or otherwise, are also now beginning to look for alternatives. Risk management has become extremely important. And so that's driving part of the movement away from China into other places. And so amidst all of this, actually, India looks remarkably good. If you're generally in the middle of a place, you'll always tend to look at the walls around you and be colored by the impression But I think the real impression only comes when you step out of those walls and look at, the condition of the building. And I think that's a little bit of what where India is at this point of time, in a rapidly slowing world with a lot of challenges, with structural issues. I think India is actually in a relatively good place. And I would take 6% growth, for some time, if, we are able to sustain it. So I think that's the first point. The second point is actually the foundations of this growth are actually pretty robust. Many countries we have seen were able to, particularly through COVID, deliver exceptional growth. And even before COVID, were able to deliver exceptional growth through high levels of leverage. We know that many countries are structurally facing inflation as a big challenge, which they're having to deal with by rapidly tightening interest rates. And those are causing serious ripples, not just within those countries, but even across boundaries. Again, if you look at India from that perspective, we were actually relatively sensible in how we managed COVID on the macroeconomic front. And so while our fiscal deficit at this point of time and our total indebtedness to GDP is on the higher side, it's actually beginning to come off since recovery. And I think we should probably get back to the commitment that we have for responsible fiscal management. And I think in the next 1 or 2 years, we should be back on track. And I think that's a pretty good place to be in. On the inflation side, while there was a lot to worry about over the last 12 months, we now actually, for the last month, are finally beginning to see inflation, cool down in India. And I think the inflation outlook, given global commodities are benign at this point of time, and supply chains have more or less resumed, and we don't have labor pressures like many other countries do. I think the outlook for inflation in India is also relatively much better. And so at least we don't have a situation where the central bank needs to keep increasing, interest rates to manage this real problem of inflation, which many other countries have had to deal with. And I think that's, again, a good position to be in, because we know that it's very tough for countries to be able to sustain robust levels of growth and economic activity with high rates. And high rates have certainly taken a little bit of a toll at this point of time here, but much more elsewhere. But I think given the outlook is at this point of time looking benign, I think that's good news for India. And finally, I would say on the macroeconomic front, one of our biggest Achilles heels always used to be our foreign exchange buffers. And what has really happened over the last 5-7 years is we've really been able to set that part of the house in order. All of you read the numbers, but now at this point of time, we've close to $600 billion in FX reserves. And importantly, they're actually growing at this point of time. They went down for a while, mainly because of the reversal in rates in the US, but now they are again growing for the last many weeks. And that, I think, is really good news for the country. It provides a lot of leverage to both the Reserve Bank of India and the government to manage the economy. It helps control inflation as well. And I think that's again good news for the country. So overall, if you really step back and think about it, the macroeconomic picture, while it could always have been better, considering that we are right now firing on 1.5 engines, and say 1.5 engines because part of exports has gone into sleep mode given everything that's happening globally. I think the 6% is actually a remarkably good number. It's going to be a while before some of the work that has been put in over the last 4 or 5 years to create new engines of growth kick in fully. The PLI schemes that all of you think of or would have heard of will have their impact. They have the potential to add at least, a point to our GDP and change the nature of manufacturing in the country. They have the ability to potentially realign supply chains in a meaningful way and reduce our risk management as well. But I think for all of that to work out probably is a journey. It's a 2, 3, 4-year journey. So today, everything that's happening is without that. We are already beginning to see some benefits of schemes that were put in place before that. And that's why I think sometimes when people are very derisive of government initiatives, it's useful to point them to things that are happening. I mean, all of us know that Tim Cook was in town this week and to open the first Apple store. I can assure you he would never come to India if India wasn't really important for Apple. But we forget a very important statistic that India was an importer of cell phones not many years ago. Apple alone made $5 billion of cell phones last year. The number could be easily double in the next year or two, not that long from now. And that's just one company, right? And this is one category of electronics, right? So these are some of the initiatives that have been taken in the last 4 or 5 years, which are now beginning to pay off. So think of PLI as something which can actually pay off 3, 4, 5 years from now and can change the nature of, how business is done in the country, how manufacturing is structured, things that we lost the competitive edge on to China in particular, winning back some of it. So I'm actually very bullish on that. I'll end the macroeconomic part of it before I get to markets with one point, which is, look, I talked about how FX has always been a little bit of an Achilles heel on the macroeconomic front, but part of the reason for that, and there's a deep correlation between that and economic shocks with what happens typically on the petroleum front. Go back, and for all of us who've been working in markets for long enough, I've been there 30 years, you realize that whenever markets have got a flu, so if it's a cold, it's, fine, but if you get a flu, India really starts sputtering, right? Every oil shock here has been contagious to the Indian economy. And therefore, and the reason for that is, our energy intensity is actually very high. We're obviously, while we are a large economy, we're also a billion people, and a billion people require a lot of energy. So our energy intensity is very high. Unfortunately for us, we aren't blessed with natural energy sources. And so all of that obviously comes from places around us, in some cases, places very far away as far away as North America and South America. And so we pay a very, very big price for these fundamental characteristics. And therefore, when it's okay when, oil's moving 5 or 10%, but when oil moves 30, 40%, as has happened in recent times, or for example, the Gulf War, we really sputter. We get a GDP shock. The government will try to do something to shield people for a while, but ultimately has to find ways to pass it on because it can't bear it. And that manifests itself in various ways, but generally it is a combination of slower growth and higher inflation. I think we have to keep in mind that I think one of the most interesting thing which is happening in our times and will probably impact the lives of the next generation is the entire shift towards renewables. We are already at a stage where the incremental capacity from renewables for now few years is much higher than the capacity being added by traditional sources in India, right? And I think that's really remarkable. Imagine a situation where, in the next decade, because this trend keeps working itself out and because traditional capacity keeps fading away, especially since some of it gets older, that India becomes essentially an economy which is largely powered by, the elements of earth, right? Sun, wind, and we get to a stage, and of course, natural gas will play an important role as well, I think nuclear, but I think that will, along the way, start fundamentally altering the nature of the Indian economy. And I think that is very, very important, something that, we should keep in mind. It reduces risk meaningfully from India. And I think it really adds to the case for India. So I think that's my broader take for India. We are in a good position. We could be better, but I think I would take where we are because of where the global scene is at this point of time. I think the government in general for the last, few years has done a reasonably good job. I think there are areas it could have done better. Disinvestment being one, for example, where just like it moved with a very steady hand with Air India, which was a wonderful asset to get rid of, given how much all taxpayers paid for it. And I think let vitalize and come back as a vibrant company. I think the government needs to do more aggressively, raise resources, as well as plug leakages by being more aggressive on divestment. But I would say overall, the government's done a pretty good job of managing resources and managing the macroeconomy. And we are reasonably well positioned, particularly given the whole digital pipe, which has got built for delivery of social services and the tax buoyancy that has created. What has all this meant from a market's perspective? I'll make a few points and then we can then open up to Q&A. Look, I think, India has always been a very interesting market for global investors. Amongst the emerging markets, is amongst two emerging markets that everybody looks at, China being the big daddy and India being the little brother. I think over the last few years, a few things have happened which are, I think, very important. The first is that the foreign investor, of which I would put two components. Historically, the most important one was the portfolio foreign investor, who we loosely call FIIs, turned very bearish on India. Okay. In fact, in the last 24 months, there have barely been any months where these people have actually invested in India, and they've taken out tens of billions of dollars from our country. They haven't taken out money out of India because they hate India. They've taken out money because this asset class has generally seen a lot of depletion globally. It's interesting that we've witnessed such a ferocious bout of selling, and yet our market's actually standing strong. So that raises the second point. Why has this happened? I can tell you, when I was running investment bank, and we were the largest market makers at that point of time, if the same thing would have happened, the markets would in India have been down 30 to 50%. Nothing of that sort had happened. It's basically because of two reasons. The first is the maturing of the Indian investor. For a long period of time, the Indian investor as an individual didn't matter. All through 90s and most of 2000, first decade of 2000, investor participation in the Indian market was very, very low. And so the people who made money and sometimes lost money was essentially the foreigners. Whatever participation happened via Indian investors, via the Indian institutions, the UTIs and the, others of the world, right? LICs. What changed in the last 10 years is the whole maturing of the Indian mutual fund industry. So if you go and just look at a simple graph of the assets under management of the Indian mutual fund industry in the last 10 years, it is absolutely remarkable to see, and actually you see it over 20 years, because you'll see how anemic it was for 10 years. And then you almost see in every 2 or 3 years, we are adding as many assets as existed in the in the entire period of history before that. So Indian asset management industry has just gone through the roof. By the way, it's also interesting that along with this explosion, you've seen an explosion in folios of women. They've almost doubled in the last 3 years, which is again a great sign of maturity of the markets, right? More people are buying. We now have a record number of folios, so the depth has increased. The good news is this is not, retail participation directly in stocks, which generally tends to be Satta, but this is mutual fund folios, which in my mind is the best way to invest, right? So I think that has helped enormously buffer this entire sell down, which has happened from the FIIs. The second thing which has happened is the growth of the private equity industry in India. When I started investing in the Indian market, when I became a private equity investor, 2007, 2008, the entire industry was really almost a cottage industry. It was like, $7 billion used to get invested by private equity. If you look at the last 3 years, the private equity industry has averaged about $40 billion a year of investment into India. The private equity industry basically massively morphs the FII industry now. And importantly, it's long capital. Unlike FIIs, they don't trade in and out. They typically hold for a period of 3 to 7 years. And they take large concentrated positions. And so that's been the other mega shift. Interestingly, private equity, which gets counted under the FDI category, is now over 50% of FDI into India consistently for the last many, many years. That also shows you how important this entire category has become to the overall macroeconomic story. FDI obviously is a very important part in balancing our current account deficit, and large part of that basically comes from private equity. So with all of this, I think we managed to actually hold the Indian equity markets. There has been a global sell-off, as you probably know. India has actually been relatively better performing in all of this. So while people get really upset that market's going nowhere, again, it's useful sometimes to take a deep breath and see what's happening elsewhere. While our markets haven't run away, this has been a period where markets have generally gone sideways. If you were a long-term equity investor, you would still have delivered, got great returns from being in the Indian market. If, you've invested for 10, 15, 20 years, unless you did crazy things, you would still have compounded your money in the mid-teens, if not higher, which is really exceptional. And especially given the tax breaks you get on long-term investing in India. So the markets have delivered really good returns. Last couple of years have obviously been a little disappointing. Because they've been disappointing, the multiples have come in. Despite having come in, I often get asked, are markets cheap? And the markets are cheap at this point of time. They're still trading above 10-year averages broadly, maybe a little bit above 10-year averages, but they're getting to the stage where I think if you look at it, they're getting back into, close to value is what we say. And if you're a long-term investor and investing regularly, equity is always going to deliver better than real estate, better than, fixed income and any other asset class. And so still there's a great case to keep consistently investing in equity. I can later on, we get into questions, talk about sectors, etc. But I would say my own view is that the markets will probably start getting attention again. One of the big trends, there was I think very good article in Business Standard this week by Akash Prakash, which summarizes it really well, is that I think India is on the radar of all the big global investors. I think the reason they haven't pulled the trigger and you haven't seen a lot of flows is mainly because, you're still in a position where, you're fighting global macro headwinds. that will change at some point of time. I think, we see that across cycles. I think the US is probably now getting towards slowing down its rate increases. We are beginning to increasingly see talk of dollar weakness. Dollar weakness will mean emerging market strength. And I think once you get to that, you'll again potentially could see a period where there's a structural bull run in emerging markets, and the biggest beneficiary of which is most likely going to be India. So the case for India, while it's always tough to say whether it goes up this month or next month or 6 months later or 1 year later, if there is a market one wants to be invested in, India is definitely one of those markets one wants to be invested in to the extent one has risk appetite. So let me pause there. I think I've gone on for a reasonable amount of time, and happy to take any questions.
Thank you. Thank you so much, Amit, for sharing and summarizing the macroeconomics in such a meaningful way, and also giving us nice insights about the Indian market. So let us take this Q&A session forward. I would like to invite Meghna Bajoria, my committee member, to take this session forward from here. Meghna?
Yes, Preeti. Thank you, Preeti. And thank you so much, Sir Amit, for sharing your valuable insights into the economy, and especially reconfirming the positive outlook for Indian equity markets for us. We have tons of questions for you related to both economy as well as your personal journey. I would like to start with asking you that globally ESG-focused investments continue to rise. So could you please throw some light on how ESG will pick up in India, and what ways will businesses transition?
Yeah, thank you, Meghna, for that question. I think ESG was a little bit of a fashion statement about a decade ago, and then we've seen it now, move towards becoming a norm. Already, I would say amongst within all the boardrooms, at least that I have been a part of, companies we own, I think it's something which is clearly seen as a necessity, as a way of doing business. And I see this accelerating. I see this going beyond the top companies into the next year. And ultimately, this will become like a value system. Right now, it's obviously, we are trying to impose values on companies by putting out this framework of what you should do on the environment and what you should do, socially, and what you should do from a governance perspective. Ultimately, I think it is at the heart of it is basically that you got to, create value by doing things right. And I think increasingly people are realizing that if you don't do that, there are meaningful costs, be it in terms of how employees view you, or be it how investors view you, or be it how customers view you, and certainly how regulators can come after you. And so it's become a very serious topic. I see it only getting more and more deeply entrenched. For investors like us, we cannot make an investment any longer without doing a detailed ESG audit. And we've said no to opportunities, even though they've been very interesting, because they fail on many counts.
Thank you for your insights, sir. Can I have Manjari for the next question, please?
Good afternoon. I wanted to ask you, please, could you share your views on the requirement to grow the Indian rupee-based PE and VC funding? What kind of interventions would you like to see from the government to facilitate this?
Yeah, thank you for that question, Manjari. I think it's really important that we do this. Just like for a long period of time, the only people who really made money out of the Indian market were a top sliver of rich people in India, and basically all the foreign portfolio investors. I think we are kind of in that same situation, dial forward a couple of decades in the private equity and venture capital world, right? Mm-hmm. There's barely any participation from Indians in this asset class, very, very little, right? And we got to change that. I think what will it take to change that? A number of things. If you see, places where these markets have evolved, where these industries have evolved, US, China, Israel, you know, of course, you need high quality professionals to come out and start them, but you also need a policy framework which is conducive to, you know, doing business for all these people, right? Often that begins by, you know, sometimes giving tax incentives. But I think, you know, in India, I think even if we don't give tax incentives and we just bring tax on parity with, you know, listed companies, I think it'll help. The problem we have is today, it makes more sense to invest in listed companies than to invest in unlisted instruments, right?
Right.
In my mind, that makes zero sense, right? The biggest, I mean, you know, I'm sure many of you all come from backgrounds where either y'all are entrepreneurs or y'all are entrepreneurs in your family. The biggest risk is taken when you start a company, right? Once a company actually is listed, the risk of it diminishes enormously. So if I was a policymaker, I'd actually think about how do I encourage risk taking so that more companies get started, more employment gets generated, more taxes get, you know, tax formation gets aided, right?
Yeah.
By creating a tax disincentive to invest in these companies, you're actually creating a disincentive for the creation of all of this, for addressing all of this. It makes no sense at all. So even if you say that, okay, look, you know, I don't want to provide an incentive, you should at least take away, in my mind, the disincentive.
Yeah.
I think the second thing that we need to think about is if this industry has got to be created in our country, is going to be created by professionals.
Right.
Sure, there'll be some families will get up and do it, but generally, this is an industry where professionals play. Okay, anyone can be an aspirant. If you look at our entire industry, look at my industry, and you look at all the people and where they come from. You look at my firm, all of us come from, you know, middle-class backgrounds, all the leaders of the firm, true for most of our peers as well, by the way, right? And so you got to think about we don't require capital to start our companies. These companies don't require capital, right? What these companies need capital for is to actually go out and make investments, right? And so we got to think about how do we get Indian institutions, many of whom are currently from a regulatory perspective in either controlled by the government or where the policy framework is dictated by the government. How do we get these companies to invest in, you know, Indian professional managers? So how do you get all Indian insurance companies to put maybe small part of their capital in PE and venture firms from India? How do you get Indian banks to maybe, you know, do the same? Unless we think about issues like that, maybe how do we create a fund of funds in India for entrepreneurship and innovation in some key areas? I think that's one thing we got to really step back and think about.
Okay. Thank you.
Most welcome.
Thank you for clarifying that.
Can we have Nidhi for the next question, please?
Good afternoon, Amit. You had mentioned, you shared regarding what you believe success comes from. You said it comes from three things: reasoning capability, emotional skills, and perseverance. Really interesting, where we're all pushing our children to, you know, do the best they can. So could you share some light on this?
Yeah, Nidhi. I fundamentally believe our education system is really flawed. And it's interesting, I see some people broadly in plus minus my age bracket, many folks seem to be much younger. But I would urge everyone to do one exercise, which is go back and think about your school cohort. Go back and think about your college cohort, okay? Undergrad as well as if you're a postgraduate holder, think of your postgraduate cohort. And really think about what are the correlations between success for people who were so-called toppers, people who are in the middle of the class, and people in the bottom of the class with outcomes in life. That's always an interesting exercise to do. I've done this exercise with many people, and you realize the correlation is, I would say, not very strong, people at the bottom of a class, generally you'll find, there is some, there's something to be said. I mean, they lack perseverance. And that does land up becoming a problem, or something. They're just disinterested in some phase of their life, and there could always be exceptions. But otherwise, you find weak correlations. I think basically the issue and the point I'm trying to make is that what we're trying to teach in schools and colleges, and what we're trying to do with our kids in our homes as well, is really getting them to embrace bookish knowledge. All the knowledge that they will need, and we are trying to get them to force them to digest, is all available on this. We don't need them to, become exceptional at being able to regurgitate all that information. But what is really needed for all of us who built companies, who sat on boards, what is it that we believe is needed for people to be successful? When we promote people as managers, when they move up the rank and, sometimes become CEOs, what is it that you see those people are good at? It is basically those things that you talked about, right? I mean, it goes beyond domain knowledge, because they can always manage people with great domain knowledge. But these people are exceptional marathon runners. They're well-adjusted individuals who are capable of running marathons, and they'll not basically fizzle out after a sprint. They're emotionally, well-adjusted and capable of dealing with the person on the left and right and top and bottom, right? They're good communicators. They can, write well and, articulate well. It doesn't always need to be in English, but whatever is the language of their choice, but they're good, communicators. And you realize that all of this lands up being actually far, far more important and a better indicator of success than just, bookish knowledge, which is what, unfortunately, our school and college systems are preparing us for 99% of the time. But yet we'll keep our kids away from the things that actually will make them successful in the long term. We'll keep them away from going and spending, time with extracurricular activities, which I believe actually are far more important than any one of us imagine, because those shape personalities and all these traits that I talked about. Interesting experiences, because experiences shape you in much more holistic way than classrooms could ever do, right? And so we'll keep our kids away from all of this, and ultimately I think then we kind of wonder why few people rise to the top. And not everybody can, right? And when the ones who rise to the top are rarely people who are really toppers.
Well said. Thank you so much, Amit.
Can we have Shalini for the next question, please?
Hi, Amit. Amit, the Ernst & Young India at 100 report predicted a GDP of $26 trillion in 2047. Can you tell us the relationship between per capita income and GDP? And why is the per capita income not going up in spite of the GDP going up?
Yeah. Shalini, good to see you here. Shalini is a childhood friend of my wife.
Good to see you.
So, I think again, let me actually take this question in two parts. I think the ENY report is actually quite bullish for those of you, who would have read it. It's, it talks of a fairly robust long-term growth outlook for India. The question of a slightly anemic per capita growth rate has to be put a little bit in perspective, in my view. Look, I think COVID, as I said earlier in my opening comments, actually set us back. And it particularly hit folks at the bottom of the pyramid extraordinarily. And I think it's taken us about 2 or 3 years to just broadly come back to where we were a little bit earlier. And that obviously that has impacted things, to a very large extent when it comes to metrics like per capita GDP. But I think what's important is to actually think of, again, what the long-term trend lines is. And what the projection that you talked about, could do. Look, if you look at India just before liberalization, I came back to the country in, just at around liberalization. India for a long time had a per capita GDP of about $250–300.
Okay.
Right? Really poor country, low income country, as we would call it. And then liberalization came, and it really started changing things. 20 years later, and I remember it was easy for me to kind of have that milestone, because around the time I left, I was beginning to think about leaving banking. The number had actually doubled. So per capita GDP in India had actually gone up. Still low income, but we had seen remarkable progress thanks to liberalization. What we don't realize is that if you think again, so that was a 2-decade period. And then if you think about what happened in the 2 decades just after that, 2003, 2004 to 2024, that number has gone up 4 times.
Okay.
So today we are at about $2,400. Now, we are getting close to what I would call a middle income country. Now, I think this is truly remarkable. We don't sometimes realize, again, the problem with the human race is that we obviously tend to be colored a lot by immediate events. And sometimes we forget, I love to read history, and, I also travel a lot, particularly to both rural areas and overseas. And you get to see, if you were to timestamp everything, you get to see this a little bit. I think the progress we have seen in India over the last 30 years is truly remarkable. Extreme poverty still exists, but I think is eliminated to a very large extent. We still have poverty, but we don't have extreme poverty. And I think that's great. And I think at the rate at which we are, likely to grow, I think we will begin to see really interesting per capita GDP stats in the next, 10–15 years, and particularly transformation in the middle class and just below that.
Fantastic. Thank you, Amit.
Can we have Shweta Singhal next, please?
Good afternoon, Amit. Amit, could you throw some more light on this? With the credit tightening happening, how does it affect the investment sentiments?
Yeah, so I think there are 2 parts to your question. One is, look, there's a global credit tightening which is happening, particularly stemming from what is happening in the US. Yeah. The US Fed has, at least not in my career of 30 years, tightened at the pace that it has tightened. Truly remarkable. And the implication of all of that is essentially, we're beginning to see things like SVB happen. And then, of course, suddenly, as soon as SVB happened, we thought that there are 4 or 5 more banks which are going to go. Yes. And suddenly people are talking about a banking crisis as if the US banking system is like a third world banking system, right? That was one impact of it. The second impact of it was what we loosely call as the funding winter, which is set in globally. Companies needing venture capital and growth capital are truly getting starved of money, because that segment of investors have basically frozen. I think that is the main implication of what is happening in the credit markets. The second part of of my response would be on, so how does that really impact India directly? Well, the equity part of it impacts India directly. Certainly, the funding winter unfortunately hits Indian companies as well. I talked earlier about foreign institutional investors and how they've been relentless sellers of the Indian equity story now for almost 2 years. That's also, in my mind, mainly to do with global macro and tightening elsewhere. If you could buy, 5% plus dollar paper, with very low risk, many investors saying, why the heck do I want to go anywhere else, right? So I think all of that is beginning to impact us. But overall, if you look at the state of our banking market, our banks are actually, I haven't seen our banks be in a better position anytime in my tenure in the financial services industry. Net NPAs are at record low levels. They're able to, grow credit. Just given ROEs are so high, they don't much of this credit doesn't need to be financed externally by a round of equity infusion. Credit growth is being matched by and large by deposit growth. For most entities, they are not trying to do crazy things. People are being quite measured by how they want to grow. And so credit is still growing in India, in the teens, low teens, mid-teens. And I think that's pretty healthy, especially given that the economy is growing now more at closer to 6%. And so I think we don't really have a issue here like what we have elsewhere.
Thank you.
Can we have Preeti for the next question, please?
Thank you, Meghna. Amit, job creation would be a challenge for the government in power, and seeing the headwinds from automation, from disruption and various advancements, what do you think would be the areas where job creation would be, where would we get job creation from?
Yeah, Preeti, that is a question that keeps me up a lot. I think, look, the world has miraculously been able to find opportunities for job creation despite innovation and disruption for all of our post-industrial history, right? Everyone thought that when the Industrial Revolution came to age that actually it would take away jobs. Actually, it resulted in adding the largest number of jobs that we ever imagined. So I think history teaches you that sometimes we think only of the downside risk, but new categories of jobs get created. And as long as you have a good educational system and a way to train people, and which is why in my mind, I think the most important thing the government needs to do is focus on working with private sector on educating and training our people. I think if we educate and train our people properly, then even though there will be displacement, which may happen in certain areas, it's okay if you stop making, going back to Industrial Revolution, you stop making cloth manually, but if you employ hundreds and tens of thousands of people in large textile machine units, that's okay, and people start buying a lot more clothes. I think we got to reimagine a lot of industries that way. And I think that may create a lot of opportunity, but I think, and we are well positioned because of how, our IT industry is configured to make use of some of these changes, in my view. Look, there are lots of opportunities that exist, right? I think we are underpenetrated on health. We are underpenetrated on financial services. Even if you look at in agriculture, our productivity metrics are very low, but while we may have a lot of employment in agriculture, if that displacement can go towards things like processing, it can create a lot of interesting, opportunities in the rural areas. So I think there's lots of interesting things that can happen there. So there are lots of segments where I think opportunity exists. I don't have answers to all the questions, as we realize even that, history didn't have answers when innovation and disruptions came. But, I think we'll have to find ways to use technology as our friend as opposed to as our enemy.
Thank you. Thank you for that insight, Amit.
Can we have Shraddha Podar next, please?
Yeah, good afternoon, sir. So Bain Capital has invested in a wide range of companies across many different sectors. How do you evaluate potential investments and determine which companies to invest in?
Hi, Shraddha. So Shraddha, I think first of all, we are clear about what kind of industries we want to invest in. We don't go chasing every industry. We are focused on 3-4 industries, the choice of industries we make are essentially dependent on which parts of the economic value chain we think are more geared up to participate in economy relative to others. So if the economy is going to grow at 6%, what's going to grow 6% plus? You just want to be in a better growing pool than in a slower growing pool, right? So I think we look at that. We look at industry structure very carefully. In some areas where, you just have a lot of over competition, you don't want to really be in there, but there's some areas where the industry structure is good. I think you can, you may want to choose to play in those spaces. I mean, which is why we like banks. We historically used to, were good investors in Hero, etc. So we like, we look at industry structure a little bit carefully. We are very careful about what the role of the government is in sectors, either as a regulator or as a influencer, be it a buyer, owner of assets, etc. The greater the degree of government engagement, the lesser our interest in participating in that area, purely because that tends to drive returns down over long periods of time, is what you learn from investing. So we look at that factor very carefully. And then of course, once we are done with all this, that takes you down to the 3-4 segments there where you can really go in and deeply understand how you want to work. So we tend to focus on consumer, we tend to focus on industrials, financial services, healthcare. We've got 3-4 verticals that we really focus on. And within that, always, I think the rules are actually relatively simple. The challenge is always being disciplined on the rules. Finding exceptional management teams, who have who already are doing a good job and are amongst the leaders of the pack, and are likely to keep building moats which are defensible and will keep benefiting from all the tailwinds and grow at an exceptional pace. Make sure that they have good ethics, governance, because that matters a lot. You can slip very easily if people make the wrong choices. So I think choosing a combination of great management teams who are, and who have good ethos, I think is really, really important. So I think that's what we do. And of course, in our case, we also work very closely with the management teams to try to get them to realize what they believe is their full potential.
Thank you, sir.
Can we have Jyoti for the next question, please?
Hello, Amit. So my question is a little different. It's on the personal front. So you spend 50% of your time at Bain Capital and 50% for social impact or philanthropy. So I would like to understand that what drove you for this and how did you structure your routine around this?
Yeah, thanks, Jyoti. So Jyoti, both my wife and I have always been interested in the social sector. We started getting engaged with the social sector actually from the month we got married. And eventually over the years, we've only stepped up our engagement, gradually. At some point of time, she moved full time to the social sector, and she runs a large organization herself. For me, actually, interestingly, my first board ever was not, a Tata or a Piramal or even my own, the own organization I used to run, DSP Merrill Lynch, but actually was a social sector board, Akanksha, organization that I, chaired. It was the organization that spawned Teach for India and as well, going back many years. And my third board was actually Give India. It was only my second board, which was DSP Merrill Lynch. So well before I stepped out and started accepting other board positions, I actually had started, accepting board positions and getting more deeply involved with the social sector. And all that happened actually, almost 20 plus years ago. And so this has actually been organic process for me. I think every passing year has only got me to feel that this has very high ROI for me. I find it more fulfilling. I find it a good use of my time. I do it selfishly more than anything else, if to be honest. I mean, and at some point of time, I realized that the one thing I've done decently over the years, both at DSP as well as Bain, and now I'm trying to do at the foundation, is I hire well. I'm a good hirer of talent, and I nurture talent pretty decently. And so even at DSP, even at Bain Capital, the folks I hired in my first year 10 years ago were beginning to get to a position where they could take more responsibility. And so I initially transitioned to a chairman role and stayed engaged. And then 2-3 years ago, I felt that the wheels could come off and they could run the day-to-day as well, and I could play more of a part-time role, and that's what I'm able to do. I think I've actively always worked to make myself redundant in organizations that I'm involved in, because I believe by doing that, I have the flexibility to still do what I want to do in those organizations, but importantly, I can then do things outside those organizations, which otherwise, if there's dependency, I would never be able to do. And that's something I practiced, at DSP, I practiced it here, and I'm practicing it at the foundation as well. The team I have at the foundation is an exceptional team. It's a young foundation. It's largely an all-women's team. We just hired our second man to fill the diversity quota. But it's we are able to, I think I'm able to spend half my time there, and I don't need to spend my full time because they're really competent. So I always tell people, I was invited recently for a leadership conference of ICICI Bank, and I was telling their top 25 officers the same thing. I spoke recently at another bank's leadership conference, that I think if we really surround ourselves with great people and empower them, then I think it becomes very easy for us to do things that we want to do.
Thank you so much for the guidance. Thank you.
Thank you, sir. And so before we end the session, sir, can you give one message for women like us, for our forum, for all of us Millennium Mams, sir?
Let me see. I'm surrounded by really talented women. My wife does incredible work. I have a team of women at the foundation who do amazing work. In my family, I have some other, again, amazing women, starting from my sister. My own realization over all these years has been that, and I've spoken to one of my mentors, Mr. Wagul, who built ICICI Bank, and I talked to him about this as well. I asked him, I said, so, ICICI Bank built this whole cadre of exceptional women leaders. What did you do different? And he said, I did nothing different. He said, you got to just let, women do what they're capable of doing. I think I've learned that exactly that same message. I personally feel that often women come into the trap where they let society, including families, unfortunately, surrounding them, decide what their potential is. So I think my most important message to anyone is, don't let anyone decide what your potential is. I think you should decide what your own aspiration is, what your own potential is. I think if you are able to break out of that mold, I think you'd be surprised how much you're capable of achieving. Because I've seen wherever, like going back to Mr. Wagul's case, if you give people the equal opportunity, men are generally outshone by women. You mentioned when you introduced me that I founded Ashoka University, co-founded Ashoka University, one of the toughest universities to get into in the country. And we run it as a pure meritocracy. No one has any influence on seats. When you have really, when you have systems geared up like that consistently year after year, we have, high 50s, 57, 58, 56% women getting in. And that just tells you that just providing the right opportunity often is all that I think, all that women need. I think the second thing I would say is surround yourself with, supportive people. You can't always make the choice of what family you're born into, but you can make a choice of who your partner is. You can make a choice of who your friends are, who your mentor is. And I think it's important to make sure that, people who encourage you, help you get to your full potential is what your, what your network is. And third, I would say is, increase your horizon in terms of knowledge, because there's such a breadth of and depth of knowledge of exceptionally talented women who've, broken every possible barrier and, and achieved incredible success. I've been hearing this, podcast called Atlanta Diaries on Spotify, and just amazing the women who basically are on the podcast and what kind of challenges they've gone through to, in each case, be a role model for others. And you realize in all these cases, it goes back to the first point that, often it was that they were just limited by what someone else told them they could do. But once they got out of that, I think they never looked back. So I would say increase your knowledge, increase your horizons, increase your exposure, and nothing will keep you back.
Thank you so much, sir. That was really very inspiring. We wish we could carry on with the session, but we value your time, sir. So I now invite our committee member from Bangalore, Jasveer Purvankara, to come for the VOT. Jasveer.
Thank you, Meghna. Hi, Amit. Thank you for giving us an incisive picture on the current economic and investment scenario. Your positive outlook towards the Indian market has endorsed our belief in our investment in our country. Your razor-sharp analytical skills and focus on impact investing are impressively laudable. Of the very many takeaways today, the one that has moved me the most is that you said to be successful, we need to move beyond domain knowledge, and we must be emotionally well adjusted. We must focus towards shaping our children through experiences as opposed to classroom scenarios. These are extremely valuable insights. Also, Amit, learning about your philanthropic contribution today has held us all spellbound. We leave the session with inspiration in our hearts to make a difference, not only through our funds, but also by contributing time and knowledge. Thank you. I would also like to thank our mentors, Mr. Vishnu Dhanuka and Mr. Sanjay Bhuwania, for providing us great learning platform. And thank you all, our members, for attending today and making this event a great success. Thank you.
Thank you, Amit.
Sir.